come from are more heavily weighted toward the equity. And here's why. So I've simplified this a little bit just to ignore some of the minutia, but the concept here, I mean, in minutia, things like, closing costs and things like that. Now that's not nothing, but just the concept here is what I'm after. If you buy a $500,000 asset with $100,000 down, 20%. So this green represents the debt, this represents your equity, and this is the total value of the property. If that asset appreciates by 5%, that is now a $525,000 asset in 1 year. I mean, this is a 1 year time frame. The debt gets paid down to $394 in that same time frame. It's not very exciting, but it's something, and it's a compounding thing. Every payment is more and more principal at an increasing rate because that line is curved as we pay the mortgage off. So it's very small in the beginning, but it's something. So you turned $100,000 into $25,000 of equity because of growth, about $6,000 of equity because of debt pay down. So you turned $100,000 into $131,000 in 1 year. That's a 31% rate of return on your asset, and there's no cash flow, and the asset appreciated by 5%. And I know we can all think of scenarios where assets appreciated a lot more than 5% recently. But I mean, that's great when that happens, but I don't want to need that to happen for the investment to do well. Is earning 31% on your investment in the first year, is that substantial? It is. It's massive. If that asset appreciates by 20 or by 5% again, now it's worth $551,000. It's not another 25 because this is a compounding thing. So now we've got $163,000 of equity. So we turned 100 grand into 163 grand in just 2 years with no cash flow and with only 5% appreciation. So we got wealthier in the first year by 31,000. We got wealthier in the second year by 32,500. In the third year, it happens again. We get wealthier that year by, we're getting wealthier at an incrementally larger rate or larger amount. So after 3 years in this scenario, and every scenario is different, but in this scenario, you doubled your investment in 3 years. You went from 100 to just under 200, and the asset only appreciated at 5%, and we haven't talked about cash flow yet. If this is cash flow neutral, you doubled your money in 3 years. Any extra cash flow will put some cash in your pocket, of course, but that's with no cash flow. Now let's think about this, because now that we're talking about 20% down or 25% down in some scenarios, that's something you can scale. You can't scale the FHA because the reason they were able to, this addresses that earlier thought. The reason they were able to invest in FHA or with an FHA loan is because they fully intended to live there. It was a residence they were purchasing. Their situation changed and they didn't refinance. But anyway, so now we're talking about something that is scalable. So if you use 20% down to get into a property, we've just seen, I'm taking the numbers out because this slide's going to get pretty busy, but this is what just happened in 3 years. So this is T equals 0. In 3 years, we've doubled our investment. These aren't to scale. That's probably a little bit bigger than double, but are you allowed to do this with your equity? Use some of it to take it out and go buy a boat. Yes. You could buy the dream car that you always wanted. Or if one real estate piece isn't enough and you want to buy another one, you can buy another one. Now that's called refinancing, right? You're taking the equity out. And in some cases, you have to refinance the first lien in order to do that. But we'll talk about rates in a minute. Rates, I'll use this analogy and then we'll get more into rates. But rates are, to me, they're kind of like gasoline. There's really nothing I can do about the price of gasoline, and it's so valuable to me that I'm going to pay whatever they ask until it's $15 a gallon. I'm going to pull up to the pump and I'm going to fill my truck when I need to, because I just need to get around. It doesn't really, it matters, but it's not going to change my activity no matter what it costs, unless something drastic happens. And interest rates are the same way. If I had this investment property and this loan's at 4% or so, and loans right now are at, 6.5 or something. If I refinance that one for a 6.5, granted, I don't want to do that just for the sake. I wouldn't refinance this and just replace the loan. But if I'm taking cash out to go and get 15, 20, 25% on another property, what the hell do I care if it's 4 or 6%? It's the price of gasoline. It's so valuable. I'm going to do it and buy another property. So now I've got both those properties doing that. Now I'm doubling that investment again, because I'm going to jump back at this because this is important. But if this is a lot for you to, if you feel like you're drinking from a fire hose, take a break and get a drink. because this is a little bit deeper than that, but I want to understand it for those of you who are like digging into this stuff. Take a look. When I turn 100,000 into $131,000 over 1 year, that's easy math. That's a 31% annualized rate of return. When I turn 131,000 into 163,000 in the second year, granted, I made more money. I built more wealth than I did the previous year, but 32,500 is a smaller percentage of my equity at the beginning of the year than 31,000 is of that number of 100,000. So this is exactly 30.902%. So we'll call it 31% of this number, but this is something like 28% or 27% of this number. So every year in which this ratio between my equity and the debt grows larger in favor of the equity, every time it moves in that direction, the return on my equity the following year, even though it is going to be a larger number if I have the same appreciation, it's going to be a larger number than the year before, but it's a smaller percentage of the equity that I had the year before. So the way you can combat this, like granted, getting more money, there's nothing wrong with that. But if you're trying to keep your rate of return higher, if you're still in growth mode with your real estate portfolio, you do that. You re-lever. I'm not a fan of like 98% leverage or 100% leverage like we saw in, up to 2008. That's super risky because if you're 100% levered and the market drops by 5%, you're upside down immediately. But 20% is reasonable. And taking 20 or 25%, depending on how conservative you are, or if you're really conservative, or if your client is really conservative, do 30 or 40% down. There's nothing wrong with that. But leverage plays a huge role in what the actual returns are. So now we have two properties doing that same thing. And now we're 6 years into it. And we've taken that $100,000 of equity, assuming no cash flow, and we've turned it into $400,000 of equity in a pretty short period of time with only 5% growth. And do you have to stop there? Like, does the government say, sorry, you can't own more than 2 rentals? Of course not. You can do that as long as you want. There are no rules against that. I mean, there are regulations where once you get to a certain level, you have to get, portfolio loans or whatever, but that's a ways down the road. This is like, I think of it like cell division, right? Every time you reach a point where you've got enough equity in one property turns into 2 turns into 4 to 8 to 16, you don't have to stop doing this. Now let's think about, so now I'm going to get back to something that we alluded to earlier, which was how do we express this in terms that are simple for people to understand who are used to getting financial information from financial advisors. So if we look at what's happening here, that green is just the debt. That doesn't represent our wealth. The blue represents our wealth. Now, if you remember, when I added these two to the mix, I did it off to the side, but what happened was those were growing at the same time as this. I just ran out of space. So what really happened was, this is that cell division I'm talking about. 1 turned into 2, turned into 4. Now, if we all we have to do is just pile it up in a way that it doesn't like they don't. That's understandable when you explain it, but this is what they're seeing in their financial advisor's office. Boy, look at that equity. Then I had it split. Now I have 2 houses. Now I have 4. Now I have 8, whatever it takes. Like, this is my wealth growing. How much wealth do I have in year 1, in year 5, in year 10? How much wealth has my $100,000 turned into? That's what I'm after. Any thoughts, questions? I'm going to glance over here. As real estate, when your clients ask you how much equity they should take out. So, okay, that's public. Everybody can see that. Juliana asked a question. What do you advise they take out? I don't have a broad brush answer for that. And I don't refer them back to their financial advisor. Of course, I think that's a bad idea asterisk. Almost everything I say has a little qualifier to it, because there are some financial advisors that are real estate friendly that are phenomenal. By the way, they're the best ones, not only, for more than the obvious reasons, but also wealthy people own real estate. And if you're a financial advisor and you want to deal with real estate, you need to come to terms with the fact that your clients are going to be investing in real estate anyways, and help them in a way that satisfies the compliance department. So they can add that to the planning. They can show, okay, 10 years from now, given these assumptions about your real estate and about your other stuff, here's what we're expecting to be. This is what income you could afford to live on if you didn't have to work, whatever. But they can't advise them specifically on real estate investments. They won't do that. They shouldn't do that. So unless I know that they're working with that kind of advisor, because that's rare, I'm skeptical and I'm hesitant to refer them back to a financial advisor. But I start the conversation about risk, right? If you want to make sure that if the market corrects and turns at the worst time for you, which would be like in the first couple of years of your ownership of that property or of the refinance, if you re-levered, then 20-25% down. If the market fell by 25% in Colorado, that would be an anomaly. That would be the first time that's happened in our lifetimes by that amount, as far as I know. I know that in the 80s there was a correction, but I don't think it was that big. So 20% equity is pretty safe if people still want to get. Another part of the risk conversation is also cash flow, right? The less you put down, the larger your mortgage payment is going to be, and the less likely it is that you're going to cash flow immediately right out of the gate with a very large mortgage and a small down payment. So sometimes it's people just like, hey, I just want to make sure that I don't have to feed this investment every month if it's a negative cash flow. So sometimes the conversation goes there where we just back into the number. How much do we need to put down to make sure that the cash flow is neutral or positive? So it could be that kind of conversation as well. So everybody's different. Hopefully that addressed that, and probably and then some. I get kind of verbose in these.